Now, let's get into the second theme, which is called dollar devaluation. We must front-run the Fed's behavior. Now, if there are any compliance officers on this call, we don't run money, we don't have a bank, and we don't have a broker-dealer. So I'm not saying front-run in the sense of the bad word, I mean in the good way. We know how these people behave. So all we have to know next is what they're going to have to behave towards. So what we're saying is that as the Fed sees slower growth data, which obviously they're already starting to see in one of their most ideological realms, which is housing, and as they start to see a rollover in classic late cycle indicators, which it would include the employment numbers, can you imagine if unemployment went from 6 to 7? Do you think Janet Yellen would get tighter in that environment or looser? I think you know the answer. I think she will start to get more dovish, the dollar will fall, and in a perverse way, you're going to get even more inflation in the face of that. That is the playbook. So again, this is the reason why we've been so outside of consensus. And at every turn, don't forget the last Fed meeting, they had to push the dots out. They did not like what consensus has been doing, which is pulling forward expectations of a taper. That was our call last year. That's definitely not our call this year. So again, you have to front run their behavior. It is predictable. Now, the 10-year versus the dollar. Okay, so on slide 22, you can see this. The positive correlation is a mathematical matter. So in other words, if she starts to get more dovish as opposed to tighter, which we've really had for the last 12 months. Tapering is tighter, and that was our call on the dollar last year. We would expect there to be a positive correlation between the dollar and the 10-year bond yield, which of course there are currently, and there have been historically. So that's the point. As she gets more dovish, then bonds go higher because bond yields are going to go lower as the U.S. dollar does. Looking at slide 26, U.S. dollar also drives real purchasing power, which I've been hitting on circuitously throughout this presentation, but what you really need to be worried about, and this is called spread risk, the spread risk between purchasing power of Americans, so we're using the U.S. dollar index as a proxy for that, the black line, versus commodities, which is a purchasing basket. And it's a proxy basket, but this has worked for us over the years. When you start to really widen like you did in 2011, you see that red arrow, you see spread risk. So again, people get squeezed. Now that's the problem. Now it's a good time to be long the consumer when there's the other side of spread risk. So in other words, the commodity basket is deflating and the black line is steady. This is called a normal economy. And I'm going to get into prior economies, which of course you've seen in this country, which are the 1980s and 1990s. That's not what you have currently. I think it's what people hope that they have. But hope, of course, is not a risk management process, and you know that.